Hello everybody, welcome back to my channel. I have 5 burning takeaways from this guy's first half results. Namely, the DPU growth, the exposure in China, which is a new market, the impacts of utilities and inflation, impact of rising rates, and of course, rising competition. So let's get on to business. So first of all, the DPU growth. It's quite a healthy growth, still 2.5% up year on year. So now it's above 5 cents for the DPU for half a year. What's quite noticeable is that the share price has really corrected in the past half year. So 1.5 year ago, it was 1 year ago actually, it was $2.49. Now it's just below $2. So because the share price has fallen, therefore the distribution yield right now is above 5% now, whereas 1 year ago it was yielding just around 4%. And actually for quite a long period of time, when the Fed was busy cutting rates and doing QE, this stuff was yielding like 3 plus 4%. And now with the share price correction, investors can finally get the yield that is more than 5%. So the accretion came from the acquisitions that they did last year. So of course the data centers in Europe, they did quite a quirky investment in bonds and preference shares issued by M1. So it's the network assets monetization. And finally, there was an entry into the Chinese market, which was quite a surprise actually. They bought one property last year, and recently they bought 2 more. So we'll look at this acquisition subsequently in greater detail. The share price fall also reflects itself in the price to book ratio. So I think 6 months ago, the price to book was kind of like 1.8 times, 1.9 times, close to 2 times. And now it's just 1.4 times. So valuations are a lot more cheaper now, because the NAV hasn't really budged that much. It's kind of constant. But nonetheless, the share price is still trading at a pretty decent premium to book. So it'll be interesting to see if they can do any more accretive acquisitions at this stage. So we'll talk about that subsequently as well. So this is quite interesting. The entry into China. So you've seen that now they bought 2 more data centers in Guangdong. So the Guangdong data center 2 and 3. So these are master leased for 15 years. So there's a lot of income stability over here. So there's a DPU accretion of 2.7%. What's also quite interesting is that this stuff is a 7-story fully fitted data center. So it's not a co-location. And there's 45 years left on the lease, which is quite long actually by Chinese standard, I think. What's quite noticeable is that they intend to fund this acquisition through debt, equity, and or cash. So there might be a small equity raising at some stage. I'm not sure when though, because the payment is going to be in tranches. So I'm not even sure if they will need to do equity. So, but there's a possibility of some equity raising at some stage. I think it's quite interesting though that when they do the acquisition, there's still an accretion of 2.7%. Because one of the concerns right now is that with rates rising and share price correcting, the cost of doing an acquisition has gone up, right? So the question is whether or not they will be able to do any accretions with acquisitions in the future. So it looks like at current structure, market conditions, accretion is still possible. It's not crazily high, but it's still in organic growth through accretion, through acquisitions. So this is still possible. You can see that this pro forma impact is done through assuming that they issue around 90 million new units at 1.87 cents. So at this kind of levels, I think it's still possible for them to do accretive acquisitions. So we'll talk a bit about the increasing competition at the final stage of this video. So stay tuned. So this is the portfolio management. I think the main concern was on the impact of inflation and rising utilities. But you can see first of all that actually this stuff continues to have very, very long WALEs. So you can see that the 50% of the portfolio by lettable area is beyond 2027. So this stuff continues to have a very, very long WALE, so ensuring income stability. While the downside to this profile is that because very few leases are maturing in the next 2-3 years, therefore even if you have a spike in the rental uh, price of data centers, they will not be able to enjoy a lot of it because well, there's a trade-off, right? Do you want the flexibility to raise rates, or do you want the stability of long leases? So in this case, you have very long leases, so you have stability, but they probably have to forego some of the benefits from rising demand for data centers and competition and so on and so forth. I think this is something quite interesting. I never really noticed this fact, but with the concern of inflation and whatnot, you can see that they actually say that the rental escalations based on CPI has more than half of the portfolio. So that's quite interesting, right? There's built-in mechanism to deal with inflation based on the official CPI. So that's something quite interesting. It's hopefully be able to beat the crazy inflation that we're seeing right now. And something else which was quite very interesting was the impact of rising utilities, especially electricity. I'm sure everybody can feel that, right? Through your household electricity prices all spiking up and the OEMs all raising prices. But for these guys, it seems that the impact is arrested because for their leases, the power is actually passed through to the tenant. So meaning to say that whatever power that the tenant uses, the tenant is actually contracting directly with the OEM, and it's not borne by the landlord, meaning a Keppel DC REIT. So a lot of the higher electricity costs actually pass through to the tenants. So that's quite surprising because I think initially, earlier part of this year, the market was really concerned about rising electricity prices and what it does to data centers, given that there's such energy gasless. But it seems for this guy is quite arrested, so that's pretty good news, I guess. So of course, the most interesting thing was most concerning thing for most people would be rising rates, right? Because the Fed is just hiking rates like bananas. But actually for this guy, it seems quite okay. So first of all, they have a sensitivity analysis done over here. Fixed rate debt is at 76%, so only 24% is floating. And also very noticeable is that the remaining unhedged borrowings is largely in euros. So main this guy, which is floating, a lot of it is actually in euros, and that helps to alleviate a lot of concerns, right? Because amongst the central banks in the world, the Fed seems to be the most keen on rising fast, and the euro seems ECB seems to be, well, they are raising rates, but not at the same kind of extent as the Fed, right? Because there's a fear that if you raise rates too fast in the eurozone, and with the escalation of tensions with Russia, you might cause stress on the peripheral countries like Italy and stuff, and further cause fragmentation, leading to a political crisis. So the ECB seems to be more keen to raise rates slowly, gradually, making sure that the eurozone don't break up or cause another country to exit subsequently. So the fact that this guy is mostly in euro helps to alleviate the rising rates concern. Over here, they do analysis and they say that a 1% rise in rates with a 1.6% impact on the DPU for the time being. So it seems quite well arrested because even if you raise rates by 1%, the impact is 1.6%. But given that this floating rate is mostly in euro, I don't think the ECB is going to raise rates that fast to the extent of 1% that quickly. So actually, the impact should probably be even less. So it's hard to say. We have to see subsequently. But of course, there's no free lunch, right? Because if you have your loans in the euro, then you're exposed to FX. And you can see that the euro is sliding against the Sing, right? So the impact might not be felt in the interest rate payments, but in the FX translation. So you have to see that subsequently. You can see that quite interestingly, they took 42% of the loans in euro versus something like 20+% of the assets in euro. So they've overhedged themselves in the euro. I guess they're trying to make use of the low interest rate environment in the eurozone. So we have to see the impact subsequently in the numbers, but I suspect it will be felt through the FX space rather than the interest rate space. But they still have some decent hedging in place in the eurozone, in the euro dollar. So I think that all in the impact on the rising rates on this guy is probably quite well managed. So this is the debt maturity profile, and of course this is where the question comes in, right? Is the central banks across the world going to hike rates forever for the next few years? Are they gonna hike rates and then stop? Are they gonna hike rates and then cut rates? Which some people, actually a lot of people are projecting, because they're saying that when you raise rates so high, it's gonna cause a recession and then they'll be forced to cut rates. I'm not sure what's gonna happen though. But I think for this guy, a lot of their debt maturity is actually very, very long. So the exposure to refi for each debt pillar is not that high also. So on the net basis, looking at these two slides, so this one and the one above, I think the exposure to interest rate rises is not that high for this guy. It's pretty well managed. But you can see that the cost of debt has risen slightly over the past few months by 10 basis points, which is still quite manageable, right? Finally, I think this is something quite interesting. Actually, this news just came out yesterday before the earnings release, which is rising competition in the data center space, right? So ESR, which is listed in Hong Kong, they're also a fund manager, something like a Maple Tree, Capital Land, the kind of model. So fund management and development, kind of stuff. They announced a first close of their data center fund for $1 billion US. And quite interestingly, they have commitments from the some of the other investors to co-invest, and the total investment capacity can go up to $7.5 billion with leverage. So that's quite a lot, right? $7.5 billion over time. So this guy is trying to launch a fund that will just buy data centers all over Asia Pacific, which they deem as a fast-growing market. And this is quite a big size, right? So if you look at the Keppel DC right now, they have $3.5 billion of assets, and this guy, the ESR fund, just the one fund alone is looking to commit $7.5 billion over time. So that shows you the rising competition in the data center space from the various players. So I think for this guy, Keppel DC REIT, the concerns about the interest rate hikes is quite well managed. The concern about inflation and rising electricity costs is also well managed. It's not going to affect them that much. I suspect that for them, the ability to do make and to source for accretive acquisitions in the Asia Pacific space amidst rising competition and a rising cost of capital will be quite very much the main thing to look out for. Can they continue to buy accretive acquisitions of good quality assets using a good funding mix? That will be something to look out for in the next few months. So that's it for this presentation. If you enjoyed what you've watched, remember to subscribe, very importantly, like, comment, let me know what I'm doing right, what I'm doing terribly wrong, and maybe even share. Till next time.